Ever notice how a $20 bill just doesn't seem to stretch as far at the Overton County Co-op as it used to?
Mm,
Or maybe you've been thinking about saving for a new truck, but your money in the bank just isn't, well, growing very fast.
right. These are the kinds of everyday things, the financial questions we all think about here in Overton County.
Exactly. And believe it or not, they're deeply connected to this um, powerful and often kind of mysterious organization, the Federal Reserve System.
That's right. And look, forget those really complicated finance shows. We're taking a personal look at the Federal Reserve, what it really means for folks right here.
For us.
Yeah. We've got some fascinating information to dig into. It's based on notes I put together back on May 6th, 2025. And also this book that, well, it offers a pretty critical perspective. It's called The Creature from Jekyll Island.
The creature from Jekyll Island. Okay.
Yeah.
That definitely grabs your attention. And, in a way, this whole topic feels a bit like a mystery, doesn't it?
It really can.
So our goal today is simple. We want to cut through some of that confusion around the Fed. We want to understand what it is, where it came from, and yeah, there's a pretty wild story about a secret meeting on an island involved.
Oh, yeah.
And most importantly, why it has a real impact on your life right here in Overton County.
Mm-hmm.
Now, we know there are strong opinions out there about the Fed. Some people are very critical of it.
Definitely.
So we're going to explore those views based on these sources we mentioned. We'll present the arguments, but, we're not taking sides here.
Absolutely not.
Yeah.
Our mission is just to get you the information clearly, quickly, so you can see how it all connects potentially to your own financial world.
Got it. So where do we start? The beginning, the origin story of this creature.
Do it. So our sources point way back to 1910, a secret meeting on Jekyll Island off the coast of Georgia. Just imagine this, like a clandestine gathering of some of the most powerful men in American finance at the time.
A secret island meeting. Financial heavyweights. Okay, I'm hooked. Who exactly are we talking about here? Who was at this hidden get-together?
Well, we're talking big names. Senator Nelson Aldrich, he had strong ties to the Rockefeller family. Henry P. Davison from J.P. Morgan Company.
Okay.
Charles D. Norton, head of a major New York bank. A. Piat Andrew, who was actually the Assistant Secretary of the Treasury.
Wow.
Frank A. Vanderlip, representing William Rockefeller's interests. Benjamin Strong, from J.P. Morgan's Bankers Trust Company. And he'd later become the first head of the Fed, actually.
Really?
Yeah. And Paul M. Warburg, who represented powerful European banking families like the Rothschilds and Warburgs. These were, the absolute top players.
That is a serious concentration of power, and they went to pretty extreme lengths to keep this whole thing secret, right? I heard something about fake names.
Oh, absolutely. The secrecy was like number one priority.
Mm.
Attendees were told, use only your first names or even code names to avoid any hint of what was happening.
Code names.
Yeah. One story even says Paul Warburg disguised himself as a duck hunter to avoid being recognized on the way there.
A duck hunter? You're kidding.
Nope. And Davison and Vanderlip apparently used the names Wilbur and Orville.
Like the Wright brothers.
Exactly. A sort of humorous attempt at staying anonymous. They were even told to act like they didn't know each other beforehand to keep up the charade.
Okay, so what was so top secret? What were these financial titans allegedly trying to cook up on this isolated island?
According to these sources, there were a few key objectives. One was basically to push back against the growing influence of smaller banks, the ones outside Wall Street's main control.
Okay, protect their turf.
Kind of.
Right.
Another goal was to create a more elastic money supply. Think of it like making sure there's enough financial fuel, expanding when needed, contracting at other times.
Elastic, flexible.
Right. But maybe the biggest goal was to consolidate the reserves, the backup funds of all the nation's banks into one central pool.
Why would they want that?
Well, the idea presented is that this would encourage all banks to lend in similar ways, follow the leader, basically, and it would provide a kind of safety net against bank runs, when everyone tries to pull their money out at once.
Ah, okay. So a way for the big players to stay dominant and maybe prevent those scary bank panics.
That's the argument made in the sources.
And this secret meeting, this eventually led to the Federal Reserve Act, didn't it?
Exactly. And the name they chose, Federal Reserve System, well, according to these critical views, that name was very strategic, very deliberate.
How so?
The word federal was meant to suggest, government control, legitimacy, while system implied this broad regional network.
Right. Sounds official. Spread out.
But the argument is that this branding was designed to hide what they claim was its true nature, a private banking cartel.
Mm.
Senator Aldrich himself reportedly boasted, after the act passed, that before, New York bankers only controlled New York reserves, but now they could control the bank reserves of the entire country.
Wow. Okay, let's dig into that phrase, private banking cartel. How does this system supposedly work? Especially, like, how does it create the money we use every day here in Overton County?
Right. This is a really crucial point where these sources offer a perspective that's pretty different from what you usually hear. They contrast our current system with some historical ones, like the old Bank of Amsterdam or Hamburg.
Okay.
Those apparently operated with 100% reserves, meaning if you deposited a gold coin, they kept that actual gold coin in the vault. They had physical backing for all the money people thought they had there.
So they were just lending out money that actually existed, that people had already deposited.
That's the idea presented, yes. Truly lending existing funds. But the Federal Reserve System, it operates on what's called a fractional reserve principle.
Fractional reserve, what does that mean?
Well, say there's a 10% reserve requirement,
Yeah.
and that percentage can change, but let's use 10%. It means a bank only needs to keep 10% of its deposits actually on hand in reserve. They can lend out the other 90%.
Wait, 90%. So they're lending out money that isn't fully backed by, like, actual cash in their vaults. That sounds, well, a bit risky for my savings account down at the local bank.
The critical view goes even further than just risky. They argue that when banks issue loans under this fractional reserve system, they essentially create new money out of thin air.
Create money? How?
It's an accounting entry, basically. There's a famous quote from a former Federal Reserve Governor, Mariner Eccles. He said, "If there were no debts in our money system, there wouldn't be any money."
No debts, no money. That's counterintuitive.
It is. But the fundamental idea here, according to this perspective, is that in our current system, money is debt. When a bank approves your loan for, say, that new tractor down at the implement dealer, they aren't necessarily taking cash from Mrs. Smith's savings account to give to you. They're creating new purchasing power on their books, backed only by your promise to repay, plus that small fraction of reserves.
So creating money with a keystroke, a few clicks on a computer these days, that sounds like a pretty powerful trick.
It's presented as exactly that. Our sources even have a name for the Fed's main tool for doing this. They call it the Mandrake mechanism.
The Mandrake mechanism sounds like something out of a fantasy novel. What's that about?
Right. It refers specifically to the Fed's open market operations, particularly when the Fed buys government bonds, like Treasury bills, from banks.
Okay, the government issues bonds, banks buy them, then the Fed buys them from the banks.
Exactly. But here's the alleged sleight of hand, according to the sources. The Fed doesn't pay for these bonds with money it already has sitting around.
It doesn't. Then how does it pay?
It creates new fiat dollars, that's money not backed by gold or silver, just by government decree electronically, essentially out of nothing. It just credits the bank's account at the Fed.
Just creates the money.
That's the argument. These newly created dollars then become reserves for the bank that sold the bond. And because of that fractional reserve system we just talked about,
The 10% thing.
right, those new reserves allow the bank to then create even more new money through loans. This is called the multiplier effect. For every new dollar of reserves the Fed creates by buying bonds, banks can potentially lend out and create maybe 9 or 10 additional dollars in the economy.
So it's like printing money, but it's all digital, like an accounting trick.
That's exactly how it's described, an accounting trick that expands the money supply.
And what are the wider implications of all this new money floating around? Does that affect the prices we pay at, say, the grocery store in Livingston?
The critical perspective emphasizes that this arrangement, this partnership they describe between the government and the banking system, has huge consequences for everyday folks.
How so?
Well, the banking system, as it's described here, earns interest on money that was essentially created from nothing. They profit from debt.
Okay.
And at the same time, the government gets a way to fund its spending without always having to directly raise taxes, which is politically unpopular.
How does that work if they aren't raising taxes?
Because the creation of all this new money leads to inflation. It acts like a hidden tax.
A hidden tax. Explain that.
Inflation subtly reduces the purchasing power of every single dollar you have. Think about it. If they suddenly double the amount of money out there, but the amount of stuff to buy houses, cars, food stayed the same.
Each dollar would be worth less. Prices would go up.
Exactly. More money, chasing the same goods and services means prices rise. So that $20 in your wallet buys less at the co-op. It's a tax, but it's hidden. It erodes your savings and your paycheck's value without you seeing a specific deduction.
A hidden tax. That definitely resonates with that feeling that our dollars just don't go as far as they used to here in Overton County. So how do these sources say the Fed's actions contribute to those ups and downs in the economy, those booms and busts we always hear about?
Well, the argument is that the Fed's variability to expand and contract the money supply, this elasticity they wanted, actually fuels these economic cycles and makes them worse. When the Fed makes credit easy to get low interest rates, buying lots of bonds, it pumps money into the system. This can lead to, well, artificial booms. Businesses borrow and invest heavily, maybe build too much. Based on this easy money, speculation can run wild.
Okay, things look great for a while.
Right. But then maybe the Fed decides inflation is getting too high, so it tightens the money supply, raises interest rates, sells bonds. Credit dries up, and those artificial booms can collapse, leading to painful recessions or even depressions. Businesses fail, people lose jobs.
So they cause the boom, then cause the bust.
That's the core of the criticism. The agricultural depression back in the early 1920s is often cited as an example. Farmers were encouraged by easy credit during World War I to borrow heavily and expand. Then, when the Fed tightened credit afterwards, prices collapsed, and many farmers were ruined, losing their land.
Wow, so farmers right here could have been hit hard by that.
Absolutely. It's presented as a situation where these monetary scientists at the Fed are constantly tinkering with the economy, trying to fine-tune it, but their interventions often end up creating more instability than they prevent.
So the very institutions supposedly designed to ensure a stable economy might actually be destabilizing it. That's a pretty concerning thought, especially for folks trying to run small businesses here in Overton County.
It's a central point in this critical view.
And what about inflation itself? That steady creep upwards in prices for everything from gas to groceries.
The connection from this perspective is direct. When more money is created, essentially out of thin air, as we discussed, it dilutes the value of all the existing money. Simple supply and demand.
More dollars, same stuff.
Right. More dollars chasing the same amount of goods and services available at, the tractor supply or the local hardware store means prices inevitably go up. It's that hidden tax, again, constantly eating away at your savings, reducing what you can actually buy with your paycheck over time.
It makes sense when you put it that way. Now, then there are the bailouts. Every so often we hear about the Federal Reserve stepping in to rescue some huge bank or financial company that got into trouble. How does that fit into this critical picture?
Right, the bailouts. The Fed acts as what's called the lender of last resort.
Lender of last resort.
Meaning, when a really big bank is about to fail and potentially drag the whole system down with it, the Fed can step in and create money to bail it out, keep it afloat.
Create more money.
That's the mechanism. The bailout of Continental Illinois Bank back in the 1980s is often highlighted as a key example. It was a huge bank deemed too big to fail, and the Fed essentially had to step in and effectively nationalize it temporarily to prevent a wider collapse.
Okay, so they saved the system maybe? What's the criticism?
The criticism leveled in our sources is that these bailouts basically socialize the losses.
Socialize the losses.
Yeah, meaning the public, you, me, everyone, ultimately bears the cost. How? Through the inflation caused by creating that bailout money, and potentially through higher taxes down the line if the government has to borrow more. But the profits that were made from the risky behavior that led to the crisis in the first place, those were kept private by the banks and their shareholders.
So heads they win, tails we lose.
That's the essence of the argument. It's described as a system where the biggest players can take massive risks, knowing that if things go badly wrong, the Fed will likely step in with newly created money to rescue them. It encourages risky behavior, they argue.
And what about smaller banks, like the community banks we have around here? How do they fit in?
That's another point raised. Our sources mention the FDIC, the Federal Deposit Insurance Corporation, which insures our deposits up to a certain limit. We all pay into that through our banks.
Right, that gives us some security.
It does. But the argument made is that smaller community banks, the ones less likely to engage in the kind of high-risk activities that threaten the whole system, end up disproportionately funding this insurance pool compared to the systemic risk posed by the giant too-big-to-fail institutions. Those huge banks get the implicit guarantee of a Fed bailout, while the smaller banks just pay their premiums.
So the little guys help pay for the safety net that mostly catches the big guys when they fall.
That's the critical perspective presented. And they point to other bailouts too. Penn Central Railroad, New York City, Chrysler, arguing there's a common thread of the public bearing the ultimate cost, often through inflation.
This paints a picture where the deck really seems stacked against the average person and maybe against smaller, more conservative financial institutions. Now, these sources also talk about this system reaching globally, mentioning the IMF and the World Bank. How do they fit in?
Right, the IMF, the International Monetary Fund, and the World Bank are viewed by these sources as essentially extensions of this central banking model, but on a global scale.
Like a Fed for the world.
That's the trajectory the sources suggest for the IMF. They argue it's potentially evolving into a global central bank, maybe aiming for a single world currency eventually. They mention things like SDRs, special drawing rights, as a step in that direction. It echoes ideas like Keynes' banker concept from way back.
A world currency and the World Bank.
The World Bank is described as basically the IMF's lending arm, but it's criticized for providing loans to developing countries that often come with significant strings attached. Structural adjustment conditions, they're called.
Strings attached, like what?
Things that can force countries to adopt certain economic policies, potentially opening them up to foreign control or facilitating corruption, according to the critics. Some even suggest this is all part of a gradual move towards a kind of world socialism, centrally managed through these financial institutions.
Well, socialism, that sounds pretty extreme.
It's a strong claim made in the source material. They point to the Bretton Woods Conference after World War II, where these institutions were created, and highlight the roles of figures like John Maynard Keynes and Harry Dexter White. The source even notes allegations about White's connections to the Communist Party.
Okay, this is getting into some deep, controversial territory. What about another organization mentioned, the Council on Foreign Relations, the CFR? How does that fit?
The CFR is introduced briefly as kind of a spin-off organization that emerged after the failure to establish a formal world government like the League of Nations after World War I.
Okay. What's its goal, according to these sources?
The claim is that its goal is to subtly influence American foreign policy and public opinion towards, well, internationalism or globalism. It was founded with ties to similar groups in other countries like the Royal Institute of International Affairs in the UK and involved influential figures. The source describes it as comprising powerful individuals from finance, government, media, the establishment, basically.
So a behind-the-scenes group pushing a global agenda.
That's the suggestion presented in the material, yes. Working quietly to shape policy and opinion.
It feels like we're uncovering layers here, a kind of hidden world of finance and influence. Now, let's turn to some of the historical players our sources focus on, specifically the Rothschild dynasty and the House of Morgan. What roles are they alleged to have played?
Right. These families are portrayed as central figures. The Rothschild family is depicted as really a dominant force in international banking history and deeply intertwined with the financing of wars for centuries.
Financing wars.
Yes. The famous quote, often attributed to Mayer Amschel Rothschild, the dynasty's founder, is emphasized, "Let me issue and control a nation's money, and I care not who writes the laws."
That's a bold statement.
It illustrates their alleged focus. Control the money, control everything. They're depicted as having a long history of profiting from conflict, sometimes by financing both sides of a war.
Both sides. How does that work?
The idea presented is called the Rothschild formula. Encourage governments to go to war, lend them the money to do it, creating massive debt, and then profit immensely from servicing that debt, regardless of who wins. War creates debt, and debt creates profit for the lenders.
That's a pretty cynical view of history. And what about the Morgans? J.P. Morgan.
The House of Morgan is discussed in the context of its very close ties with English financial circles, and specifically with the Rothschilds. There's an account of the Bank of England reportedly influenced by the Rothschilds, bailing out a company connected to Morgan's predecessor during a panic in 1857. The suggestion is that Morgan effectively served as a Rothschild agent in America after that.
An agent for the Rothschilds.
That's the implication drawn in the source. And Morgan's firm played a huge role in financing World War I. Initially, they helped finance both sides, according to the source, but later became the main purchasing agent for the Allies in the U.S., earning massive commissions.
Profiting from the war machine.
That's the charge. And critically, individuals connected to the Morgan Empire, like Benjamin Strong, who we mentioned earlier.
The first head of the Fed.
Exactly. They were key players at that secret Jekyll Island meeting where the Federal Reserve was conceived. The connections are drawn very tightly.
So these powerful banking families are alleged to have not just profited from, but actively shaped global events and even wars through their control of money.
That's the narrative presented. Our sources really delved into this, connecting finance to conflict.
What are some other examples they give?
Well, they suggest the Rothschilds financed both Napoleon and his enemies during the Napoleonic Wars and made a fortune after Waterloo by getting early news of the victory.
Wow.
There's also a claim exploring J.P. Morgan's financial interests in shipping and suggesting a potential link between those interests and the sinking of Lusitania, which helped push the U.S. into World War I.
They're suggesting Morgan had a hand in the Lusitania. That's a huge claim.
It's presented as a question based on his financial stakes, yes. Very controversial. The sources also assert that the Bolshevik Revolution in Russia wasn't just a popular uprising, but was significantly financed by wealthy financiers in London and New York.
Wall Street funded the communists.
Figures like Jacob Schiff of Kuhn, Loeb and Company are mentioned, along with funds allegedly provided to Trotsky. Even the American Red Cross mission sent to Russia after the revolution is viewed with suspicion in these sources, presented as potentially a cover for Wall Street figures looking for profitable business concessions from the new Soviet government.
A Red Cross mission as a business venture.
That's the allegation. And it goes further, bringing up the idea of the best enemy money can buy, suggesting that Western finance and industry continued, even during the Cold War, to provide assistance that helped build up the Soviet Union's military and industrial power, creating a perpetual enemy that justified massive military spending in the West.
This is truly eye-opening. And frankly, a bit unsettling, this whole perspective on history, finance, and global events. So, given all these deep criticisms of the Federal Reserve, what solutions do these sources actually propose? They advocate for getting rid of it entirely, right? Abolishing this creature.
Yes, absolutely.
Yeah.
Based on the arguments laid out that it fails its objectives, that it's a cartel, an instrument of usury, an engine of unfair taxation via inflation, that it encourages war, destabilizes the economy, and pushes towards totalitarianism.
Mm-hmm.
The conclusion drawn is that the Federal Reserve System must be abolished.
Abolished entirely. So what's the alternative? What kind of system do they envision instead?
They outline what they call a realistic scenario. It involves several pretty major steps.
Okay, like what?
First, obviously, abolish the Federal Reserve Act and the whole system. Shut it down.
Step one?
Step two, freeze the current supply of Federal Reserve notes, the dollars we use now, with maybe some specific exceptions. Basically, stop creating more of them.
Stop the presses, digital or otherwise.
Right. Third, redefine the real dollar, not as a floating fiat currency, but tie it back to a specific weight of precious metal. The source strongly advocates for silver, specifically 371.25 grains of fine silver, which was the historic definition.
Back to silver. What about gold?
Gold would be part of it too. Establish gold as an auxiliary reserve with its value, its exchange rate with silver, determined by the free market, not fixed by the government.
Market-determined ratio.
Then, restore the free coinage of both silver and gold at the U.S. Mint, meaning anyone could bring bullion and have it minted into official dollar coins.
Like it used to be.
Exactly. Then, a big one, pay off the national debt.
How?
By using all those Federal Reserve notes that are already out there, which, under this plan, would no longer be the official money. Use the old fiat money to cancel the debt that was run up using it.
Interesting. Use the old money to wipe the slate clean.
That's the idea. Then, reform banking. Go back to a system where banks have to clearly separate demand deposits to your checking account money, which should be 100% backed and instantly available from time deposits, like savings accounts or CDs, where the bank could legally lend that money out for a specific term. No more fractional reserves for checking accounts.
Clear separation. Seems logical.
And finally, and this is considered absolutely crucial for the whole thing to work, a massive reduction in the size, scope, and spending of the government itself.
Smaller government is key.
Essential in this view. A sound money system, they argue, cannot coexist long-term with massive government spending and intervention.
So basically, a return to a system based on tangible assets like gold and silver with much less power for central banks and a much smaller government footprint. How does this radical shift relate back to, our listener right here in Overton County? Why should they care or support something like this?
Well, the argument is that this kind of system would bring far greater economic stability and transparency. It would remove the alleged manipulation and all the negative consequences, the booms, the busts, the inflation that they attribute to central banking.
The stability sounds good.
And a currency directly linked to gold and silver, they argue, would hold its value over time. It would protect the savings of Overton County residents from being constantly eroded by that hidden tax of inflation. Your $20 would buy roughly the same amount of stuff next year or 10 years from now.
Protect purchasing power. That's huge.
And furthermore, by eliminating the Fed's ability to just create money tied to debt, they argue you'd prevent those artificial booms and busts that can be so devastating to local businesses, to farms, to livelihoods right here in our community. A more predictable, honest economy.
Those are certainly some profound ideas, big changes proposed. Now, our sources also briefly touch on possible futures, pessimistic, optimistic, and offered some advice on preparing. What are the key takeaways there for our listener?
Right, they sketch out two rough paths. The pessimistic scenario involves things like, well, more banking crises, the IMF possibly becoming that world central bank we talked about, maybe UN supervision of assets, restrictions on using cash, international digital IDs, basically a more centralized, controlled future.
Doesn't sound great.
No. But then there's the realistic scenario, which is basically the abolition plan we just discussed. They suggest this is possible if current trends are reversed, maybe after some kind of major economic chaos forces people to demand fundamental change.
So change is possible, but might require a crisis first.
That's the implication.
Yeah.
As for preparation, the advice given is pretty practical. Financially, get out of debt as much as you possibly can, with maybe exceptions for like a modest fixed-rate mortgage. Choose your banks carefully, look for sound, maybe smaller local institutions. Diversify your accounts, keep balances under the FDIC insurance limit per bank, maybe use bank rating services to check their health.
Okay, practical financial steps. What else?
Personally, become informed. Really understand these issues. Don't just take our word for it or anyone else's. Dig into it yourself. Then, become a pamphleteer. In their words, share what you learn with friends, family, neighbors. Talk about it. Join forces with others who are concerned. Form local study groups to learn together and discuss what's happening and what could be done.
Educate yourself and educate others. Get organized locally.
Exactly. The core message is that the future isn't set in stone. It's what we choose to make it. But averting those negative scenarios, they argue, requires actively understanding and reversing the current trends.
Some serious food for thought there as we start to wrap up. So for our listener in Overton County, maybe pondering all this, here's a final provocative question to chew on. After this deep dive into these very critical perspectives on the Federal Reserve, what do you personally believe is the single most important thing for the average person right here at home to truly grasp about our financial system? And maybe more importantly, what specific actions, big or small, might that understanding inspire you to take in your own life, maybe in our community?
Yeah, that's the real question. And now is absolutely the time to engage with these ideas. We really hope you'll delve deeper, discuss this stuff openly, respectfully with your family, your friends, your fellow residents right there in Overton County. Think critically. How might this information change how you handle your own finances? How you see the bigger economic picture? Maybe even research the health of your local banks. Look into community-based initiatives that promote local economic strength and resilience. Be proactive.
Absolutely. And if you found this deep dive valuable, maybe a bit unsettling, but thought-provoking, please do like, comment, and subscribe. It helps us continue exploring important topics like this together.
And now let's close with a moment of reflection. Heavenly Father, we humbly ask for your guidance and your wisdom as we try to navigate the complexities of the world around us. Please grant us the clarity to discern truth from falsehood, and give us the courage to act with integrity for the well-being of our families, our neighbors, and the prosperity of our communities. Amen.